All right, good evening, guys. Ken at Tortoise Capital, weekly foundations check-in. I think this is like session 11-ish. We'll just keep going all the way up through, end of July. And I got a new cohort starting in July. You guys are welcome to attend those. And keep sending your questions. I will prioritize their questions, but if they don't show up or if they don't ask questions, then I'll just keep answering. Let's see. All right, so the main idea of the sniper is that there's the best targets for a critical state have to do with location and volatility. And so the idea that the target has put himself in that target box, and we're sitting over here as the sniper from Sanctuary, and when this guy makes a bold move, we've got a window of opportunity in our range fan that we can shoot at. We are calibrated out to that distance. We've rehearsed all those, and there's like five. There's going to be 5 patterns that we're looking at. There's sort of there's the setup that put the guy into the box, right? There's probably 5 or 6 of those things. So there's 5 setups. But once they're in the box, everything that's in the box is prone to make a bold move across our field of vision in which we can execute 5 patterns. The hybrid frog, supported spring crossing, Kata 2, collapsing dragon, and then the Z3 pinch. A superset of that is the super pinch, special case. So the hybrid frog is the one that comes right from the opening. What we've said is that whenever it opens, we can put an MMRB on either side of that opening. And then if it breaks this way, we can be long with a stop right here. And if he breaks this way, we can be short with a stop right here. And so in each case, we're using an MMRB. So that's right from the open. These 3 in the middle all require that there was a harsh winter first. And then after that bottoms out, which is going to lead to, at some point, a PSAR flip, somewhere in this box, we're going to see an SSC, and if it works, we're likely to see a series of Kata 2s all the way up. But if this fails, then we're going to see a collapsing dragon. Oops. So these 3 in the middle all require that there was one particular condition of the harsh winter. Now, how far does that have to go intraday? It has to be, in my view, like 1.5 frog boxes. That's like 4 MMRBs, which means that if you got that short, here was one move from the open. There was the one move that got you in, and then it had 3 more of those. If you saw something like that, it would indisputably be a harsh winter. And if you were checking down on the MACD histogram, you would absolutely see that this thing had sold off harsh, and it was short of the, or it was below the Red River. So there's no question that you need to see that harsh winter. And then this combination of three little patterns in this box gives you everything that you need, in my view, to trade, starting at about 10 minutes or 30 minutes after the open. Because if you've got, especially, if the market closed here and then had a big gap down, well, this thing is already in play. So if it was a large gap, then that implies a larger than normal move. We just don't know which direction. And that could be a range stat to the upside, all the way down to a range stat on the downside. So you're going to get this largest possible playing area based on the fact that you have a large gap. A large gap means it's in play. And then it's not unusual that after that large gap that opens here, then you get a quick entry, and that thing just sells off harshly. Now, if it gaps to here and sells off harshly and then starts that morning hook, the size of that move there kind of tells you that, well, it's either going to be a huge move down, or maybe this was just a tactical move to collect all of the stops, because maybe all these guys were looking to go up, and so these guys gapped it down and ran it down. They collected all the stops, so they've got all the inventory that they need, and then they reverse that thing, and then that morning hook takes off, and it closes the gap and then continues on, and then that becomes an enormous move. Well, that's the kind of move where you see a harsh winter and you get that whole SSC element, and then if it does collapse, you've got the collapsing dragon that's leading you downwards, and that's the one you love. But if it reverses, you get the SSC, and if it's actually going to go all the way back to the opening, then you're likely to see a couple COTA 2s on the way up. Now, those COTA 2s are either going to be, you entered and then you exited, and then you re-entered and exited, and you re-entered and exited. So you get three separate and distinct small chunk trades. Or maybe this thing just goes so far that the little pullback didn't even bump you out, and then what you're able to do is have 1, 2, 3 positions on it, and then it becomes massive. All right. So that's what I want to say about those first 4 patterns. Any questions on any of those? That's a review, but sometimes you hear it for the first time. There's got to be a better way to erase all that. All right, so now the 4th pattern, or the 5th, I should say, I'm sorry, the 5th pattern is what happens after, maybe we had this gap opening, and then we got the harsh winter, and then maybe the SSC and a couple COTA 2s worked, and then instead of going up any further, and instead of collapsing, it didn't collapse, it just kind of mucks around into this sideways choppy crap. And then what you get is the initial Z3 lines expand really large because of the gap and then the big sell-off. So you get you get the widest possible distance between the Z3 lines. But then, as this starts to narrow through here, now suddenly the absence of volatility makes this start to compress. And then you get this kind of a factor. So there's some point in here when it stops going up, but it also doesn't fail, is what we would think of as the chop. So at some point in here, once this thing has started to, the Z3 lines have started to collapse, at some point we just got to stop trading that thing, and we got to stay out of this sideways quiet channel in the river, because it's now sideways. It has a lack of volatility, and every little pattern where we're trying to take the PSAR flips and all that, this sideways quiet channel is where the crocodiles live, and that's killing us. So what we've got to do is, in the SQC, we got to not trade. And we got to be stalking that. And what we've got to do is see how narrow those Z3 lines get until they become a Z3 pinch. So a Z3 pinch means I've got one frog box, which is about 3 MMRBs, the RL10s. So about 3 of those. And if the Z3 lines are both contained inside the frog box, then what we have is a clear range compression. And now what we have is we have a Z3 pinch. And that is tradable. And now what we do is we wait for the breakout of the Z3 lines in either direction. And then we can have the space between the Z3 lines, which is about probably the size of an MMRB, maybe a little larger. But now that becomes our risk box. And now we're going to play one of two patterns. It's either this thing is going to monkey around here and then it's going to just go. So we buy the breakout. No matter which way it breaks out, we buy that breakout. Or we're going to get a fake 1 and then it goes 2. So unless this thing works right away, we scratch it right where we bought it. It just blips up and blips back. We scratch it, and then we immediately stop and reverse, because now what we're doing is we're playing to the far side of the channel. And then if this breaks out, now we're going to get 2 units of gain, because it gave us fake 1, go 2. And it works the same way on the bottom side. If this fails to fail but then reverses, we scratch it fast, and then we stop and reverse right away, and then we get about 1R if it gets to the far side of that channel, and then if it breaks out, it really goes. And those are quite often the biggest moves. The fake 1, go 2. I can't tell you how many times I've seen, things get sideways, gets really tight, and then it goes blip and go. Or blip up and then go. Because it's like they're collecting all of the easy money on the breakouts, just getting some inventory. So what that gives us now is that we have all these things that are in the sniper box, these sniper targets, and there's going to be about 5 different setups that tell us these things are candidates for making big moves, because the sniper box is a critical state. Every one of those patterns is in a critical state. And we're over here in our safe firing position, and we're just waiting for these things to move hard. And that's where we get those 5 patterns. Hybrid frog, right from the open. Then the SSC, Kata 2, collapsing dragon sequence. And then when those stop moving and we get a sideways quiet channel, which we don't trade, but that helps us stalk. If that thing continues to compress, that's going to lead to that Z3 pinch, and then that could lead to a super pinch. So the SQC we don't trade, and then if the Z3 lines continue to compress to where we have a frog box, right? That should be black. So now we have a frog box. Now, because the Z3 lines are both inside that frog box, we have a Z3 pinch. And wherever those Z3 lines pinch to gives us our breakouts. But what if it doesn't break out? What if this thing just keeps grinding? Well, then this box just continues to go. And it could be that we get a super pinch. And that's the best case of all. Now, in the super pinch, what you have to see is you have to see the Z3 pinch, plus you're going to see 4 regression lines all contained within that same frog box. So the 4 regression lines are all appearing in there, which is the 270, the 90, the 30, and the 10. When all 4 of those regression lines have come from wherever they were, like sometimes you might see the 270 was way up here, I'm sorry, or maybe the 30 was way up here, and then he comes in. And the 270 may have been way down here, and he rolls up. And then the 90 may have been, something like, here. Now the 90's in there. And then the RL10 is almost always inside there because that's really correlated with price. But when you see all 4 of those and the Bollinger Bands inside that frog, you have this complete mongasso of a tight compression that looks like an acorn. And this is the best pattern of all, because in this moment what you have is no volatility, and you have all 4 regression lines agreeing that this is the fair price. Each one of those regression lines represents a different demographic. The 10 period represents traders. The 270 represents long-term buy and hold. And then the 30 and the 90 are kind of intermediate, like swing guys or whatever. But you have a full range of 4 different demographics, and they all agree that this is the right price. And there's a lack of volatility. So now when you get breakouts from a Z3, from a super pinch, you can ask yourself, how long can it stay there in that circle? Well, either forever or until price breaks out. And then when price breaks out, obviously, it has to be the RL10. The RL10 follows price immediately. And then if that keeps going up, at some point the RL30 comes out. Now, when the RL30 comes out of the river, so if I have the river, that's plus or minus 1Z, and there's that Bollinger Band mean. And everything is tightly compressed. When the RL10 breaks out of the river, followed a little bit later by the RL30, when the RL30 breaks out of the river, So you have price out, the 10 is out, and the 30 is out. We define that as the beginning of trending behavior. It's like the RL10 and the price got us in, and then when the 30 comes out, we can say, yeah, officially the trend has begun. If that thing goes far enough, you get 2 or 3 legs up, pretty soon the 90 comes out, and then if we're really lucky, the 270 comes out. But that takes a lot of favorable price action for the 270 to come out. So those are the 5 patterns that we are going to trade. Hybrid Frog, the cluster of 3 of the SSC, Cotitude, Collapsing Dragon, and then if everything quiets down later in the day, the sideways, it becomes sideways quiet channel. Then we wait for the Z3 pinch and the super pinch. And oh, by the way, that works on swing trades as well. Only instead of a frog box, you're going to use 1 or 2 ATR to set up the critical box. So that's pretty useful. If I'm intraday, my critical lens, the choke point that everything has to fit into is the frog box. If I'm a swing trader, you got to experiment with that a little bit depending on your target. But that box is either going to be 1 ATR or 2 ATRs. That's enough of a pinch on a swing so that when you do get the big breakouts, you're going to get between 2 and 4 ATRs for sure, which gives you your 2-to-1 reward to risk ratio. You're going to get a big move. So the focusing lens there is the frog box intraday or 1 or 2 ATR on the swing, depending on your target. Check or hold? All right, so now what we want to do is, so that's what we did with things that were in the box. They were in the target box. They were already in a critical state. And we said that was going to come from location plus volatility. And then once it started moving, it was one of those 5 patterns. So we know how to trade that now. Now what we're going to look at is this. Now we're in a position to answer Brian's question. So now we're going to take a look at how do we set those things up. Well, the sniper looks at 3 different look-back periods. 150, 30. I include the 10 period because that is just a useful, helpful swing trade time frame. But for the patterns that we're looking for, like the Godzilla, it's really these first 2. The 10 period is gravy. That's just, if it's in an extreme condition for location on the 10 period as well, that's just fine. That's just dandy. But really, it's the 150 and the 30. And so we're going to say, the way we compute that on location is we're going to look back 150 days, and we're going to find the high of the last 150 and the low of the last 150. And we're going to say the top 10% and the bottom 10% are going to be overbought and oversold. Those are special cases. And the reason for that is that when it gets to an extreme, of that look back period, everybody who's looking at the market over that long period knows that this thing is either going to break down huge, or it has all of this room to go back to the high. And even if it just gets a 50% retracement, the size of that is going to be 1, 2, 3, 4. You know, if this represents 10%, then each one of these is like a little step ladder, and there's 4 of those just to get back to the 50-yard line. So when it's in this oversold condition, the collapsing dragon style sell-off is a no-brainer. Because whatever the size of the move from the high to the low was, there could be another one of those. Or you just look back further into the past and you say, hey, where was the previous support level that held? You know, and then you can set those up as targets. Those are easy. The recovery trade tends to look like this, climbing up the steps before it falls out the window. The pathway from this collapsing dragon is straight down and miserable. That's why we love that. Okay. Similarly, if this thing is near that high of that period, it's overbought, and it's either going to take off and break out huge, or it's going to revert back to the mean. And this one is nice because, like the collapsing dragon down here, this one often is a quick fail because fear is more powerful than greed. So a collapse from overbought, the only thing better than that is collapse from oversold. That's the best collapsing dragon. And then the second best one is the one from this extreme condition. So we love to see the extreme condition on the 150. And it's the same logic on the 30. The bottom 10% in here and the upper 10% in here are critical states. And the and the move from out of here is either going to be large up or large down. And the move from here is either going to be large up or large down. So now what we want to do for the sniper is like the Godzilla. Now there's about 5 different patterns. The one I prefer is the Godzilla. What the Godzilla wants is something that is in the bottom 10% of the 150, and we want to see that the 30 is down here as well. So he's oversold dramatically on both of those. Both of these guys are conditioned that if this thing could collapse. And most of the time, you will also see that the 10 period is oversold. So the normal looking pattern on the Godzilla looks like this. That the 150, the 30, and the 10 are all absolutely miserable. And it's in the bottom 10% of all of those. And when that collapses, it's huge. Now, what's not unusual would be to see something that was overbought on the 10, and it could still be, whoops, that should be red, sorry. Yeah. This thing could still be oversold on the 30 and the 150 and be overbought on the 10. So this is something where you had like a big sell-off, and then the blip on the 10 was just that first little bump up. So on the 10-day, it looks like, hey, it's overbought, but it's been so bad that this is just a dead cat bounce, and then it gets smashed. In fact, when both the 150 and the 30 are both oversold, and the 10-day is overbought, if you're long, you better be running for cover, because it is rare to see a perfect V bottom. You are much more likely to see this thing oscillate and then slowly move up, like we saw with the S&P over the last 6 months. So we're looking for the 150 and the 30 to be oversold, and then the 10, it's a bonus if that's at extremely overbought or oversold, but it's not absolutely required. So that's what I want to say about location. Now, the Godzilla is the best because he's oversold and oversold. But there's things like the fireworks, which are overbought and overbought, and those things could go up or they could collapse. The fireworks is like the opposite of the Godzilla. That thing has already had this amazing move up, and it exploded, and everybody loves it. And now you say, oh, is there going to be another bang where it goes up higher, or is it going to just fall back to the earth? So I don't want to spend too much more time on the 5 patterns. The Godzilla is plenty, and the fireworks is plenty. Other than just to say, we also notice that a pretty good one is this fence sitter, because what you got, if you have the bottom 10% and the middle 10% and the upper 10%, there's actually 3 units of reward before it gets it back into the comfort zone. And so if something was horrible and then gave you a 50% retracement and then stabilized, even though it's smack dab in the middle of the trading ranges, the very fact that it's compressed and right in the middle is you could see a 3-to-1 move there or a 3-to-1 move down to here. You might also see 2 units down and then a move up, and then you'd know, well, I'm already into my Kata 2 now. So what starts off as a Godzilla could become a fence sitter, could become a Kata 2. And these things start chaining together. All right, so the only thing that remains now for tonight is to talk about how to compute that 5-day volatility. And Brian, you've been patiently waiting. So we're going to take a look at the last 150 days. And for each one of those days, we're going to take the high minus the low divided by price equals a range percentage. And you have to do that because over 150 days, this thing could have gone from 50 to 100. And if the range was 2, that's a 4% range percentage. And if it moved 2 over here, that's only a 2%. And that is a significant difference, right? So we have to use this formula, high minus low divided by price, to come up with the range percentage for each of the last 150 days. Check or hold? Now what I'm going to do is I'm going to take this into 5-day chunks. Because 5 days feels like a normal swing time frame, or a normal swing trade, or it's 1 week. All right. So now what I'm going to do is I'm going to take the last 5 days from day minus 150 to day minus 146. And I'm going to find the high of those 5 days minus the low of those 5 days and divide it by the price of the 5th day. And that's going to give me a range percentage of that 5-day period. Check or hold? So that means if I divide that by 5, that's going to give me 30 . that's going to give me 30 5-day periods, correct? And then what I'm going to do is I'm going to rank them by max to the min to the average, and then I'm going to find the standard deviation, and then I'm going to compute the standard deviation and the z-score. Excuse me, z-score. So I found the min, the max, the average, and now this area in the middle, so this is a z-score, let's see, of 0. This is a z-score of 1, and that's a z-score of -1. Okay? And then anything better than 1 is going to be, this is going to be abnormally volatile plus, like it is exceptionally noisy. But if it's less than -1, this thing is exceptionally quiet. That thing is abnormally quiet volatility. And it turns out that both of those conditions of abnormal are very significant, that they are special. Price behaves differently when it is very, very quiet and when it is very, very noisy. When it's very noisy, so I'm going to put it on an array this way. So if this is abnormally noisy, this range in here is the normal. This is abundantly quiet. That is really volatile. Both of those are extreme. When things are quiet, that's like that Z3 pinch has pinched in here into a little acorn, and now it's ready to explode, and this catches everybody by surprise. Oh, never saw that coming. So that means it's prone to make a large move because that first thing shocks people, and then the momentum players come in, and then off it goes, and now it is in play. So we love to see things that are abnormally quiet. Check or hold. And we also want to see things that are abnormally volatile because they're already in play. That's very much like the SSC. The SSC needed to see a harsh winter in order to set up the SSC or the collapsing dragon. So we had to see that it was in play. So if you are abnormally volatile already over the last 5 days, it's already in play. Now here's a practical thing that we learned. We learned that volatility is not symmetrical. That once you get below the average to -1, it's almost never down in here at all. The histogram looks like this. Where here's one. Where there's just not much on this side of it. So what I take as abnormal for the sniper is anything that is less than 0. So even though this says normal, I take anything that has a z-score less than 0, I say that's quiet. All of that is quiet, and that's good. And the only thing that I'm treating as normal is a z-score between 0 and 1. It's trading, but there's nothing special. But anything greater than 1 is double good. That's in play. So here's how we compute that z-score then. So you get those 30 5-day range percentages. Then you calculate the average. You calculate the standard deviation. And then you take today's reading. So you have these 30 day, and here's the day minus 5 and day minus 1. So whatever this reading is on this day is today's reading. Today's 5-day range is today's reading. And then you had 3, 4, ... all the way out to the 30th 5-day set. So what you do is you take today, let's just call that T. You take T minus the average divided by the standard deviation, and that equals the z-score. And then again, anything greater than 1 is volatile. For purposes of the sniper, between 1 and 0 is normal, and anything below 0 is quiet. Okay? So let's take an example. Let's say that the 5-day range percentage of these last 5 days was exactly the average of the last 30 days. Then you would have today's number minus the average. That would equal 0 divided by the standard deviation. So it's going to have a z-score of 0. Check or hold? And then if today's score was exactly 1 standard deviation larger than average, you would get this minus average would be equal to a full standard deviation. You'd have SD divided by SD, and you'd have a z-score of 1. So the z-score measures on a z-score ladder where today's reading falls on that scale. If it falls right on the average, the z-score is 0. And that would be a z-score of 1, 2, 3, 2.5, 1.5, etc. Okay? So that's how we compute the 5-day range percentage. Now, there are some other patterns that we use. I haven't really talked about them much because the Godzilla has been so good. But I'm developing a course and building out those little structures. So the Godzilla requires on the 150 and the 30, which is equal to the weekly and the daily. The tactical is the 10-day. So for a Godzilla, it has to be less than or equal to 0.1 and 0.1. And then anything on the 10-day is fine. And then I also want to see either, for volatility, I either want to see quiet or volatile. So it excludes the middle. It had to be oversold on both of those, and the 5-day was either volatile or it was less than 0. And then that qualifies as a Godzilla. Check or hold. So we always want extreme conditions. Now, here's some other patterns just to tease you a little bit. So a fence sitter, we want that to be quiet. If he's right exactly in the middle of his 150 and his 30, then there's a large move to either condition, and it's not even a breakout, and it has compressed into such a small volatility. This is like a Z3 pinch with a large move to the extremes of the range. It's the opposite of a breakout. It's a breakout from the middle of the river. It's like right in the middle of Godzilla Crocodile River. But apparently the crocodiles were so full from eating all of the zebras that they're asleep, and it got super, super quiet, and now the herd can run in either direction. So that's called the fence sitter. The fireworks needs things that were in the breakout zone on both of those. So it was in the very highest high of the last 150, and in the last 30 days, it's all the way up in here. And then we want to see the 10-day is either at an extreme ready to break down, or is also at an extreme ready to break out. So that's what the fireworks looks like. The fall from grace is immense. A second leg up is an amazing breakout. And what makes that powerful is the fact that the 10-day period is not also in the middle of his consolidation zone. The 10-day move just made a move to an extreme, and that gives you the information that it's in play. All right? And then we also want to see it at a hesitation. We'd love to see dojis. It has to either be quiet or volatile. So you get the 150 overbought, the 30 overbought. The 10-day you would like to see either overbought or oversold, one or the other. And then you want to see either quiet or volatile on the volatility. And that gives you massive fireworks. Okay? Now, there's a couple other things that we've learned, that if you just look at the volatility. Now, we also do a one-day volatility where we take a look at today's range and compare it to the last 150 days of range, which we already computed so that we could come up with this. And if that thing is like very quiet or very noisy, that's excellent because it's a one-day in play. Large range, or the absence of volatility meant it was an extraordinary doji. Either one of those, a very large move or the quietest move of all, is a predictor of a big move regardless of location. So that's why you also see me putting the 5, the Z5, and the Z1 in there. And what I like to see is super quiet and super quiet. That thing is like the super pinch ready to explode. I also like to see super quiet and one-day volatile. That means the previous 4 days were very quiet, and then today was the first day of big movement. That means tomorrow might be the second day of follow-through. So that's good. I like to see 5 days super noisy and 1 day super noisy. That is like an enraged Godzilla. That thing is just going with no sign of ever wearing out. So that's good. And then I also like to see very quiet, very noisy on the 5, but then quiet on the 1. That means this thing was enraged for 4 days and then today finished in a doji. Perfect. Was this the turning point that brought it back this way, or was that the pause that refreshes? I don't know. But the fact that it's a doji today, after being in play for 4 big days, and then it settles into a tiny little doji, I'm ready to have no directional bias, but I'm ready to go long or short. So just the Z1 and Z5 comparison gives you very interesting ideas. If you combine that with the locations of the 150 and the 30 and the 10, you can start getting all kinds of combinations to put things into the box. All these things are simply saying, look, we've identified a critical state box, and these targets are in it, and every one of the things that's in here is prone to make a large move in any direction. And how am I going to trade that large move? I'm going to trade it with one of 5 patterns. Next day, hybrid frog, SSC, Kata 2, collapsing dragon, or when things calm down, the Z3 pinch, super pinch. So, make sure you're very clear that there's reasons to put things in the box and prepare them and not be surprised when they move. And in the morning, I have all of those and I'm waiting for the first mover. As soon as the first one out of the box, you got my attention, let's go. Those tend to be the biggest movers right away because they're already in play. It's moving now. What do I already love it because it's in my target box. So the previous discussion last week or so about how to find the movers or what constitutes unusual behavior, all of those things pertain. Okay? So that's what I wanted to say. That's the short answer on how to compute 5-day volatility and how to put that in the context. Once you start playing with volatility, you will lose your fascination with directionality and prediction. Guaranteed. Once you start appreciating the difference between 5-day and 1-day volatility, that's all I think you need to be a good short-term trader. Because that is simply that's the electrocardiogram of the heartbeat, the stress level of the traders that are out there trying to make sense of all this shit. I'm not trying to make sense of anything. I'm trying to find critical states and trade off their psychology. Their psychology is the Z1 and the Z5. Where they are on the playing field just adds gravy. If they're at an extreme location already, then exactly when it breaks down, half the guys are elated if it breaks down, and half the guys are in a panic. But if it breaks up, half the guys are elated and half the guys are in a panic. That's exactly what I want. I want a range compression that brought these things into this tight little doji and then a big move out of there. I have a small risk box, a large follow through, lather, rinse, and repeat. And that thing happens at breakouts on the upside and at the downside, and even in this quiet little neglected breakout right here in the exact middle of the entire trading range. If that thing compresses, you want to talk about complacency. That's complacency. That one always catches guys by surprise. But the follow through isn't huge because you only get half the channel. I know that. So I'm going to get paid fast and I'm not going to stick around. It's not a huge move until it breaks out of the complete trading range or reverses from the edge of the trading range. That's how you maximize the combination of volatility and location. Volatility and location get you to sniper trading. And you're sitting over here in a safe spot where the herd cannot trample you and where the crocodiles cannot eat you. And when those things start just running across your field of vision, you're just taking your shots. And you got a bag full of ammo taking your shots. 5 setups to put them in the box, 5 setups to trade. Done. You got about 20 different symbols to track. Pick the 5 that are the most critical state-ish. There's your 5 to prep for the morning. One of them's going to move. Find the one that moves. and then kill it, and then bring something home to the tribe. All right? That's everything I want to say for tonight, and we're going to clear the deck. And this little piece of text over here, let me get that out of the way. Yeah, this says exactly the same thing I said before about the 5-day and the 1-day. There's 4 states, you know. And each, when they are abnormal, when they're both abnormal, it must be interesting, but for different reasons. 5-day quiet, 1-day quiet, man, that's going to be an explosion. When it finally goes, that's the tightest little doji in a series of 5 little tight dojis that you ever saw. That's what that looks like. When that goes, it goes big. And then the next one is that quiet 5, but the large. That's the first day out of the box. But it's got 4 days of quietude and now 1 day of big moves. Could it be one of those? 2 more days of fall? Yeah. Could it be a false breakout and it comes back this way? Yeah, could be. But the next day after the first big move, second day follow through is either large up or large down. Oh yeah, maybe it sometimes gets really quiet, but then you don't lose any money. This one is second day momentum. This one is the explosion. This is essentially a daily doji plus a weekly doji, and they both break. And then the 5-day volatile and the 5-day volatile, 1-day volatile. This thing is enraged. That's the enraged Godzilla. It is just so much in play. That's all you can see. I mean, the thing is just running crazy. And then the volatile quiet is maybe 4 days of big volatility, finishing in a doji. And then you say, okay, maybe that's the turning point, or a continuation. The least likely thing is it stays exactly right there forever. Like suddenly, after 4 days, they found the perfect price, and that was it? Done? No. So each one of those has its own little explanation, its own little pattern. And you can find the ones you like. I love this one, super quiet, and I love super noisy already. It's already in play. Okay? So as you see me working through those 30-minute charts, that's like I'm looking at trade locations and volatility and turning points and some of that stuff. This lens ends up becoming a style or a strategy. And you can make it as mechanical as you want and turn it into a system if you want. I just find it immensely artistic and flexible. Very adaptive. Okay? All right, that's everything I got for you. I'm going to shut her down, get the recording going, and then I'll see you in a little bit. Okay? Cheers.